All right, so should you buy a home in 2023 or 2024, or should you wait? And if now's not the time, when is the time? Now, this is definitely a question. It's a hot topic right now that a lot of you want to know because a lot of you are faced with this decision, perhaps this year or maybe next. So we're going to jump in and dive into that today. Talk a little bit about that. Now, one of the things I want to point out is that real estate is hyper local. That means that a lot of the things we discuss today will have to do with your particular market and each individual situation. Now, it is impossible to time any market in any asset class. However, smart, savvy investors are always looking at indicators to judge what's likely to happen, not just what they hope is going to happen or what the mass media is saying is going to happen. Smart investors look at data, and that's what we're going to look at today, because right now we're in a window of time that there are definitely some opportunities where the average buyer out there is negotiating some great deals in the real estate market. But how can we know with reasonable certainty that the market isn't going to crash and leave new home buyers left holding the bag, as they say? One thing that we're recognizing is right now the fact that institutional buyers like JP Morgan Chase, Blackstone, and a bunch of others on Wall Street, they've been raising massive amounts of funds and ready to jump back in the market to purchase single-family homes again in this current market condition. Now, the fact that they're doing this cannot be ignored and definitely has consequences for all of us who might be thinking about buying a home this year or next. From what I can tell, this is either lost on much of the general public, or many have been scared away from the market altogether. Now, my wife and I own a primary residence and currently own several rental properties and are always looking for opportunities to expand our portfolio of real estate. Now, one of the cool things about real estate is that no matter how much money you make in your day job, owning real estate will absolutely grow your wealth faster than anything else I've seen. When you're talking about real estate, you're getting the entire appreciation of the entire asset with only a small investment, while you're able to leverage the bank's money to fund the majority of funds needed to make the purchase. Now, if you think about it, if you wanted to buy $50,000 worth of stock, you need $50,000. However, that same $50,000 could be used perhaps to purchase a $500,000 home for yourself, or a $250,000 rental property. This is a huge advantage over other asset classes and a way that the average investor is able to get ahead financially much sooner. And it's not just the appreciation of the real estate itself, it's the tax advantages, the loan pay down, which also builds equity, and the monthly cash flow that comes from owning rental property. Now, cash flow, of course, is known as passive income, and passive income is what you make while you're sleeping. This is the best type of income. Warren Buffett said you'll never truly be wealthy until you figure out how to make money while you sleep. Well, owning real estate is the easiest way for the average investor to do this. Now, when I was young and starting out, I used to think that rental property was just a big hassle to have to deal with the tenants and the maintenance and all those types of things. What I realized, though, is that a great property manager can take all of this off your plate and you still come out a winner. It's just a win-win situation. Now, had I figured this out sooner, I would definitely own more real estate than I do today. But like I said, in the beginning, there are going to be opportunities in any market. The question is, how do we find the best real estate deals in the current market that we're in? So we're going to go over a few things. Number one, we're going to analyze some key points of data in this current market. Number two, we're going to discuss how to find the right deals at the right price. And number three, we're going to talk about how to negotiate and structure the deal, as well as how to structure the financing so it's in your best interest when you walk out of the closing. So whether you've never bought a primary residence or you already own a home and maybe you're looking to buy your first rental, this video is going to shed some light on what the outlook is for this year and for next, and how to take advantage of this current environment. Now, if at any point during this video you feel like you want to skip ahead and go ahead and book a chat with me and my team, you can hit the link below and go ahead and do that, and we can get on a call together to talk about your specific goals and scenario. So, as we all know, real estate has been on a tear the last few years. But starting with the middle of last year, there's been a pullback, and that's what we want to talk about here. How to capture opportunities during this pullback. Now, the media likes to use the word crash, and there's even some prognosticators out there that predict a crash. You'll note that almost every one of these people who are predicting the crash have tried to predict previous crashes and have been wrong every single time. Now, a pullback of 5, 10, or even 15% is a good thing for a healthy market. Now, if you think about it, if prices were up 30% in your market over the course of 2 years, or maybe 50%, or maybe even 100% over the course of 3 to 5 years, a pullback of 10 to 15% is only knocking off the last 6 months or last year of appreciation. So real estate is still up for the long term, and if you look at real estate, historically, it's always gone up, but nothing goes up in a straight line. Now, this is probably a good place to talk about the fact that the current recession that we're in, or we're almost in, is nothing like the Great Recession of 2008, which absolutely was tied to real estate. One main reason why the 2008 recession was tied to real estate and caused prices to tumble 50% in such a short amount of time was because there was an industry in the mortgage world called the subprime market. Now, the subprime market produced subprime loans, and these loans did not require income verification or asset verification, and they were called no income, no asset loans that they were actually given out to people that had scores in the mid 500s. Now, a lot of these loans had adjustable rates that started with a high rate and it was only fixed for maybe 2 years, and then it became an adjustable rate, sometimes called a 228 loan that was fixed for 2 years but then had a 3-year prepayment penalty. These were terrible loans for people. When the rate adjusted even higher, people were unable to make the payment and they walked away because they didn't have any equity. Over 36% of all home loans in 2007 were adjustable rate mortgages. Today, only about 8% of loans are ARMs, and more than 80% of those ARMs operate under a fixed rate for the first 7 or 10 years. Also today, home equity is at an all-time high. The average homeowner has about $300,000 in home equity. Homeowners are not going to walk away from that kind of equity. Today, total mortgage debt is less than 43% of home values. That means negative equity is basically non-existent. So the subprime loan industry literally does not exist any longer. Today, you have to show 2-year job history, proof of income, proof of down payment, and credit score requirements have all been raised. Today, more than 70% of home loans go to those with credit scores over 720. Now let's talk about inventory. In 2007, 2008, there were 3.8 million homes on the market when the housing market crashed. That was 13 months of inventory. Now today, you only have 1.2 million homes on the market, which is only 3 months of inventory. This is less than half that's needed in a healthy housing market. So there was a housing surplus in 2008, and there's literally a massive housing shortage in 2023. Now in 2007, 2008, 10% of mortgages were delinquent, meaning they were 30 days or more behind. Today, only 3.6% of home loans are currently delinquent. That's 2.5 times more delinquencies back then than compared to today. Foreclosures. Well, in 2007, 2008, you have 4.6 million homes that were in foreclosures. Today, less than 1% of homes are in foreclosure, only 0.6%. Now, like I said before, real estate is hyper-local, so that means what we're talking about today is going to apply to most markets. But if you're in a market that's had a massive run-up on prices, there is going to be a little bit more room for risk. Now, after the 2008 crisis, there was an entire decade of 10 years that went by where there was a massive underbuilding of homes. Now, in 2005 to 2008, there were 8 million jobs lost. Not the case now. Back then, you had only 138 million jobs. Today, you have 159 million jobs. Now, sure, you have layoffs, but there are other jobs being added, so you have to look at the net job gain. We just don't have the massive layoffs and the millions upon millions like we had in 08. Currently, we also know that unemployment is extremely low. In fact, an article just came out that said it's the lowest since 1969. Now, we can talk about whether that's 100% accurate or not based on different data points, but the fact is that unemployment is low right now. So to summarize, in 2008, you had a huge run-up of prices in homes, fueled by some serious fear of missing out. You had serious FOMO going on. But what we have today, people are frozen and confused because 2008 being the rearview mirror, perhaps their parents or they themselves lived through it. And so now they're dealing with the fear of making a mistake. So as I mentioned earlier, there are some major real estate funds that are gearing up to purchase single family homes. Both Blackstone and JP Morgan Chase have beefed up specific real estate funds for purchasing homes, which puts them in direct competition with the average buyer, which is you and me. Another chart we want to take a look at is this one, which shows how drastically underbuilt new homes have been over the last 10 years. When you have dramatically less homes built in the last 10 years than any 10-year increment in the prior 50 years, this is going to be a problem. Now, what this means going forward is a massive shortage of homes. Now, when there's a shortage of homes, or another way to look at it, a lack of supply, we know that there's more competition, and that means that prices are likely to continue to stabilize or to go up. Now, in many markets, stabilization is already occurring, and people are already seeing multiple offer situations come back. This does not mean that in some hyper-local markets, there could be still some dips to come. Now, let's take a look at interest rates. Now, behaviorally, interest rates are the primary driver in America when it comes to demand for real estate. Last year, we had the largest interest rate increase in a single year in history. Rates literally doubled from roughly 3% to 6%, and they ended up peaking around 7%, but now they're actually pulling back more to a more stabilized range. It's important to note that a very common misconception is that the Fed is moving mortgage interest rates. This is not the case. Mortgage rates move with inflation, inflation drives mortgage rates, and they're dictated by the trading of mortgage-backed securities, which are essentially mortgage bonds. Fed is moving short-term rates up and down, not mortgage rates. In fact, as of this filming of this video, the Fed still has 2 planned short-term rate hikes, but mortgage rates have actually been declining. Think of short-term rates as rates that affect car loans, small business loans, and home equity lines of credit. These are all affected by the federal funds rate, which banks simply add 3% to that federal funds rate to come up with the prime rate, which is a rate that we're much more familiar with when we hear the word prime rate. So in the last couple months, we've actually seen inflation come down. And with that, mortgage rates have followed suit and come down along with the inflation. Now, we need to keep an eye on interest rates because, like I said, behaviorally, this is how most buyers make their decisions. But we can see here that most analysts are predicting rates to stay in the mid-5s, maybe low 6s. And the mid-5s is historically when buyers will re-enter the market in the masses. Now, while I do not ever see mortgage rates going back down to the 2s and the low 3s, and by all accounts, that was really an unfortunate situation because it caused a lot of problems with inflation. And really what you had is you have people now who did lock in those rates in the 2s and the 3s and really anything below 4%. Those folks are not in a hurry to move. And that's really creating a new dynamic in the market that we haven't seen before. People are in love with their interest rate and they're choosing to stay in their home rather than sell. And that's creating even more pressure on inventory. There's just less homes on the market. So when you have all these factors conflating together, they all support stability in the market, which just means we're not going to see a real estate crash like we saw in 2008 because there's too many factors that say otherwise. And the fact is, where is the inventory going to come from? The market is just completely different this time around. So how does the average investor like you and me take advantage of this short pullback? Because that's what's happening here, and this is how Wall Street and real estate funds make more money. They buy quality assets at a discount. And the secret's out, single-family residences are quality assets. Well, one of the ways to find good deals is by finding motivated sellers. And motivated sellers are people who need to sell. Perhaps maybe something's going on in their life, like a life event, a divorce, a job transfer, job loss, something along those lines. In these situations, the sellers are more likely to be negotiable on the price and/or help with the buyer's closing costs. Another motivated seller could be the institutional buyers or maybe the builders. Now, institutional buyers who now are looking to sell could be someone like Open Door or maybe even like some smaller companies that were doing some fix and flips, but now they have too much inventory on their books and they're just simply looking to unload. One example of an institutional buyer is Open Door. Open Door is a company who purchased a bunch of properties last year across America and possibly even in your market. Now, what you need to do is if you can go to Open Door's website, you pull up your local market, you can actually see what's available there and what they have for sale. You need to know that Open Door is going to be negotiable with these homes. There are deals to be had there. So another area of opportunity right now are going to be builders. Builders, they've got a lot of inventory in their books and they're looking to unload this inventory. Now, you're going to see price cuts with these builders, but what they're definitely doing right now is they're offering seller concessions. So when you go to make an offer, you definitely want to ask for seller concessions. I read the other day where 75% of builders are actually paying for closing costs on the behalf of the buyers. They're also paying for interest rate buy downs to buy down the interest rate. They're either doing this with a temporary buy down or a permanent buy down. So what this means is a lot of the buyers who are winning in this market right now are already getting rates in the low 5s, the high 4s, or even sometimes in the high 3s because the builder's agreeing to pay a huge chunk of money towards closing costs for the buyer, which can be used to buy down the interest rate. This is huge. Now, another opportunity we're seeing right now is on the higher end price range of homes where they're already overpriced to begin with, and now we're seeing steep price cuts from the original list price. Now, this is where having a great realtor on your team will help you find these because oftentimes these properties have dropped out of the MLS and a good realtor can help you find those and perhaps reapproach the seller and negotiate a great deal. But here's the thing, you can do a lot of the research yourself by using software to help you find homes. Software like PropStream can be a big help, but this is also where if you want to hop on a call with my team and I, we can actually help you locate deals and talk about your specific market. So once you identify a property, how do we know what's an appropriate offer to make so that you get the property at a discount? Now, getting the property at a discount is obviously the goal because you want to provide a cushion just in case there's a little bit more of a pullback. You'll also see that a lot of analysts are predicting actually a housing gain, even though it's a little small gain, but this year and next, as opposed to a housing market coming down. So when you decide to make an offer, you want to make an offer less than list price. How much of that will depend on your particular market. But one of the most important things you need to do when structuring your offer is to ask the seller to pay all or some of your closing costs. Now, just like builders are agreeing to pay concessions on behalf of the buyers, sellers are doing the same things. The sellers want to get rid of their home and they need to make the deal sweeter for the buyer to entice them to come back into the market. So what we are seeing is a huge uptick with sellers paying buyers' closing costs, which, as we mentioned before, also includes buying the interest rate down. And when you're talking about an interest rate buy down, you're talking about something that maybe starts out at possibly, say rates are at 6%, the seller can pay for a buy down and you start out with possibly a 4% rate. That's a huge difference and saves you hundreds of dollars a month on your monthly payment. So one of the things that me and my team do is we work with you to figure out what is the best use of the funds that the seller is going to offer on your behalf. In other words, should we use those funds strictly for closing costs or should we use some or all for either a temporary rate buy down or a permanent rate buy down? Now, these are all things that we work alongside you with and your realtor to determine the best course of action for you as you move forward. Another thing that we're seeing right now in this market is the seller agreeing to pay for repairs or for upgrades. Now, this was not the case last year when sellers were selling properties as is and not making any repairs. Now, it's a lot easier to negotiate these repairs or upgrades and actually even build it into the price. There's a couple of other options we're seeing as opportunities right now, and one of those is seller financing. Now, this is just where the seller agrees to carry back the note on the financing directly between them and you, the buyer. Now, this happens sometimes when maybe the buyer is unable to qualify for traditional financing, but maybe they have a large down payment, and so the seller has the ability to finance the property on behalf of the buyer by carrying the note back instead of the borrower having to get like a traditional loan. Another option would be an assumable loan. You may have heard of those in the past. They're not as common anymore, but this is where the seller has a mortgage note with a really low rate already, and if the loan is assumable, then the buyer can possibly just take over the note or assume it, in other words. Lastly, you may have heard of what's called subject to financing, or sometimes just shortened to sub-2. SUB-TO. Now, this is a little bit similar to assumable loans. However, in this case, there's a third party involved that actually takes over the note and the buyer pays the third party. So you as the buyer do in fact own the property, but you have taken over the existing financing. Now, the phrase subject to just comes from the fact that you are buying the property subject to current financing. Again, the whole reason why you'd want to do this is to be able to take over a lower rate and a lower payment than you'd be able to get in this current market. So it just creates a win-win for the buyer and for the seller. Now, if you want to explore taking advantage of some of the opportunities that are going on right now in this market in this window of time, because I do think as we move deeper into 2023 and in 2024, the competition is just going to get tougher. But right now, my team and I are setting aside blocks of time each day to do one-on-one consults for those of you who want to explore your own personal situation in your own market and how you can take advantage and uncover opportunities that exist. Now, on these calls, we can break down the numbers and we can see if a certain deal makes sense for you or what you need to be doing to look forward in terms of price point to get you the payment that you want. Also, if it's an investment property, we can provide you with a pro forma, and that's going to let you know whether the deal is good enough to give you the cash flow that you need. Now, we do spend a good amount of time with each individual client and are happy to do that for a select number of people. So if you want to grab one of those spots, just go to the link below and you can book a one-on-one strategy call at a time that's convenient for you. Now, typically these are Zoom calls, so you actually get to see us and we get to see you. These time slots do fill up quickly, but we're happy to go through the numbers with you if it's something you're interested in exploring more. I know there's going to continue to be some amazing deals to be had this year, and we want to help you in any way we can. Now, sometimes that means connecting you with a top realtor or top builder in your market, and I've got relationships all over the country to be able to do this for you. So this brings us to an end here. I appreciate you watching. I hope you found this video helpful, and I look forward to seeing you again soon.